You ever have that feeling like you're running hard on a treadmill, maybe even inching forward a bit, but financially you're just not getting anywhere?
Oh, yeah, that sense of working hard but not seeing the rewards match the effort. It's incredibly common.
It really is. I know it well. Like, when I started out full of optimism, fresh out of college back in '04, landed a job as a middle school teacher.
Right, the start of a career.
Yeah, but then fast forward 3 years, putting in all the dedication, and I'm still, living paycheck to paycheck. It was really frustrating.
I can imagine that disconnect must have been jarring.
Totally. So in my article over on BullishBooks.com, Escaping the Salary Monkey Trap, I really try to unpack that. Like, why does this happen? And maybe more importantly, what can we actually do about it?
And it's interesting because that feeling, that stuck sensation, it cuts across so many different jobs and income levels, doesn't it?
Absolutely. I remember hitting this low point just thinking, why am I so poor? This job sucks. Okay, maybe a bit dramatic, but the frustration was real.
Uh-huh. Yeah, those moments happen.
And the usual advice, work harder, be patient, wait for that raise. It didn't feel right. I thought, I'm not everyone, and I refuse to just wait. There has to be another way.
That dissatisfaction can be
No.
a powerful motivator, though.
It was for me. It really kicked off this long journey of trying to figure out how money actually works. Went to grad school, got a Ph.D., thought that would be the key.
The traditional path, right? More
Yeah.
education equals more security.
Exactly. And yeah, my income went up, sure. But that feeling, that underlying financial juggling act, it didn't completely vanish. Even with a good research job, it made me realize, okay, the usual markers, they don't automatically equal real financial freedom.
Which brings up a big question.
Yeah.
Why doesn't that standard formula, education, hard work, saving, always deliver the financial results people expect?
That's the million-dollar question, isn't it? And grappling with that led me to different thinkers like Robert Kiyosaki and his book Unfair Advantage. He talks about this thing called the salary monkey trap.
Ah, yes, the monkey analogy.
Right. Picture a monkey. It reaches into a jar for some fruit, grabs it, but now its fist is too big to pull out. It's stuck.
Not by the jar, but by its own grip on the fruit.
Exactly. It won't let go of the fruit. And that fruit, for us, can be the paycheck. That familiar, seemingly secure thing that actually keeps us trapped.
It's such a good way to visualize the psychological side of it. We cling to what we know, even if it's not getting us where we want to go.
Okay, so how do we start to see our own fruit, understand the trap better? Kiyosaki uses this framework, the Cash Flow Quadrant. It's pretty straightforward.
E, S, B, and I.
Right. E for employee, S for self-employed or small business, then B for big business owner, and I for investor. Now, for a long time, I was squarely in E. And many people operate in E or S.
Trading time for money, basically.
Pretty much.
Yeah.
As an employee, you trade your skills for that paycheck. As an S, maybe a freelancer or small shop owner, you've got more freedom, maybe, but you're still the engine. Your income is tied directly to your hours, your effort. There's a limit.
And it's interesting how our whole education system often pushes us towards E, maybe S,
Totally. But it doesn't really teach us much about B and I.
which Kiyosaki argues are the quadrants where real wealth is built.
Exactly. B is about building systems, businesses that work without you being there constantly. And I is about making your money work for you, investing.
But think about the messages we get fed.
Oh, yeah. All those limiting beliefs. The rich are unhappy. I'd rather be poor and content. I actually heard that.
Seriously.
Yeah. In college, someone genuinely said they'd rather be poor and happy. And the professor brilliantly asked, have you actually been rich? How do you know?
Huh, good point. We adopt these ideas without really testing them.
Or hard work and promotions are the only way. Or save aggressively. Live below your means. My own mother, bless her, is the most frugal person I know. Saved diligently her whole life.
But did it lead to significant wealth?
Sadly, no, not really. And that's not a knock on her. It's the system. Then there's higher education guarantees, better pay. My own story shows that's not always the full picture.
Right. It can increase income, but
Yeah.
not necessarily create freedom.
And the big one, investing is too risky. It's basically gambling. Or the safest thing is just a diversified portfolio of stocks and bonds. These are all those tempting fruits keeping people stuck.
So you start looking at what financially successful people do differently beyond just working hard in an E or S job.
Exactly. And that research, which became the foundation for my article and building on Kiyosaki's ideas, pointed to these 4 key unfair advantages the wealthy often use. The first one is financial knowledge.
But not just knowing about money, right? More like understanding how it works.
Precisely. Actionable knowledge. And this breaks down a bit. First, understanding history, like the history of money itself.
Okay.
For example, since the US dollar came off the gold standard in 71, its purchasing power has plummeted like by about 90% gone.
Wow, 90%.
Yeah. And then you look at the national debt. What is it now? Over 124% of GDP. And it keeps climbing. So the idea of just saving dollars long term, well, you start to question that strategy, right?
That historical context really puts the just save money advice into perspective. It's maybe not enough on its own.
Not if the money itself is losing value. Okay, second part of knowledge. Clear definitions, especially asset versus liability.
The classic Kiyosaki definition.
Right. Most people think their house is their biggest asset, but Kiyosaki says an asset puts money in your pocket. A liability takes money out.
So the mortgage, the taxes, the upkeep.
Makes that dream house often a liability, at least initially, from a pure cash flow perspective. Wealth builders focus on buying things that generate cash. Okay, third element, tax intelligence.
Taxes, everyone's favorite topic.
Yeah, but it's crucial. Taxes aren't just expenses, they're like a code of incentives from the government. People who understand the tax laws can often structure things legally to pay proportionally less tax.
It's not about evasion, it's about alignment. Using the rules as intended.
Exactly. They align with what the government wants people to do, invest, build businesses, create jobs. Fourth piece, strategic debt.
Okay, that one scares people. Debt, ill bad, right?
Yeah, that's the common wisdom. But there's good debt and bad debt. Bad debt drains you credit cards for stuff you don't need. Good debt is borrowing to buy an asset that produces income.
Like a loan for a rental property that generates positive cash flow.
Exactly. Used smartly, debt can be leverage, potentially offering returns you just can't get saving alone. And the fifth part of knowledge is this dual perspective.
Meaning?
Well, school teaches us to be consumers of finance, how to get a mortgage, how to contribute to a 401k. The wealthy also understand how to be on the receiving end, how to issue the loans, create the investments, be the bank, essentially.
Shifting from just playing the game to understanding how the game is actually set up.
You got it. That's a huge mental shift. Okay, so that's advantage number one, financial knowledge. Advantage number two builds on that, tax strategy.
Going deeper into taxes.
Yeah. As an employee, your taxes typically come out first, before you even touch the money.
The W-2 reality.
Right. And often, the harder you work, the more you earn.
Yeah.
The higher your tax bracket, potentially, you pay more.
The reward for hard work is a bigger tax bill.
Kind of feels that way sometimes. And think about standard advice. Max out your 401k or traditional IRA. Okay, fine, you get a tax break now. But what happens when you retire and take that money out?
It's taxed, usually as ordinary income.
Exactly. At whatever the income tax rates are then. But investors dealing in capital assets often pay capital gains tax.
Which is often a much lower rate. Currently around 15% for long-term gains for many people.
Big difference. So the tax system itself often favors income from investments over income from labor. It incentivizes being an investor or business owner.
So while those retirement accounts have their place, understanding the different tax treatments is key to a broader strategy.
Absolutely. Okay, advantage number three, leveraging debt. We touched on good versus bad debt.
Right.
But look at the big picture. The U.S. national debt, what, 35, maybe $36 trillion now? It's huge. That tells you something about how our financial system runs.
That debt is the system, in a way.
It kind of is. Banks need borrowers. They make money lending, not just holding deposits. And the tax laws. They often favor debtors. You can deduct interest on investment properties, for instance.
So savers are lending money to the bank for a tiny return, and the bank lends it out to borrowers, often for activities that get tax advantages.
Exactly. Strategic debt lets you aim for returns savers can't really touch. But, and this is crucial, I'm not saying go wild with borrowing.
Oh, definitely not. Responsibility is key.
Absolutely. Start small, learn, manage it carefully, focus only on debt for assets that produce cash flow enough to cover the debt payments and then some.
That distinction between debt for consumption and debt for investment is everything.
It really is, which leads to the fourth unfair advantage, risk management.
Okay, because the common fear is that investing, especially outside of safe stocks and bonds, is just too risky.
Right. Play it safe, don't lose money. But like Warren Buffett says, risk comes from not knowing what you're doing.
It's about competence, not just avoiding action.
Think about driving a car. Is it risky? Sure. But you learn the rules, you practice, you manage the risk. You don't just refuse to ever get in a car.
Good analogy.
And this idea of a well-diversified stock portfolio being the ultimate safety net, Well, history shows even that can be risky. What about long bear markets? The Great Depression wiped people out for decades. Recovery took 25 years for the market.
Right? Diversification within one asset class doesn't protect you from the whole class going down.
Exactly. Now, contrast that with folks operating in the B and I quadrants. They might be aiming for much higher returns, 20%, 30%, sometimes even 100% or more ROI.
Which sounds riskier to most people.
It sounds riskier, but they'd argue it's lower risk because they understand the investment, they control it more directly, and often they get better tax treatment on the gains.
So their diversification is different.
Yeah, it's often across different asset classes,
Yeah.
real estate, businesses, maybe commodities, paper assets, all focused on cash flow and tax benefits. This creates this like self-reinforcing cycle of wealth building.
While the middle class might focus on acquiring liabilities, thinking they're assets.
And those struggling financially often just focus, understandably, on cutting expenses, just trying to survive. The wealthy focus on acquiring income-generating assets. That's the fundamental difference.
So it all comes back to shifting that focus. How does someone actually start escaping that salary trap?
The absolute cornerstone, the foundation, is education. Financial education.
But people say, I don't have time, I don't have money for courses or books.
I know those are the common roadblocks, but often they're the very excuses keeping people stuck in the trap they want to escape. You have to make the time. And look, many successful capitalists, many entrepreneurs, they didn't start with a pile of cash.
They started with knowledge.
Yes. They learn the game first. Then they use that knowledge to find opportunities, to structure deals, maybe to attract capital from others. Financial education compounds, just like money. Learning a little bit consistently over time adds up hugely.
It's not just reading, though, right?
Yeah.
It's applying it.
Oh, absolutely. It's active learning. So what can you, the listener, do? Like right now or starting this week?
Actionable steps.
Yeah. First, question the traditional advice. Just because everyone says it doesn't mean it's the best path for building wealth. Dig deeper.
Be skeptical in a healthy way.
Second, invest in your financial education. Seriously. Read books. Kiyosaki's a starting point. There are many others. Check out websites. Shameless plug. BullishBooks.com has resources. Find reputable courses if that's your style. Make it a priority.
Treat it like investing in any other valuable skill.
Third, study successful people. Not just celebrities, but real investors, real business owners. How did they actually do it? What are their strategies, their mindsets?
Look for patterns.
Fourth, look for ways to generate income not tied directly to your hours. Passive income streams, even small ones to start. It changes your mindset.
Start thinking like an investor or business owner, even on a small scale.
Fifth, learn the basics of tax strategy. You don't need to be a CPA, but understand how depreciation works, capital gains versus ordinary income, deductions for business or investments. How can the tax code work for you, not just against you?
Knowledge is power, especially when it comes to taxes.
And sixth, connect with like-minded people. Find others on this journey. Share what you're learning, ask questions, build a network. It makes a huge difference.
Surround yourself with people who are thinking differently about money.
Yeah. Remember, the goal isn't just to work harder in your job, the E or S quadrant. It's to learn how to work smarter using the principles of the B and I quadrants.
That shift from pure effort to strategic action.
So, wrapping this up, escaping that salary monkey trap, it really demands a big shift. A shift in thinking, letting go of those limiting beliefs, that fruit we talked about.
Recognizing what you're clinging to.
And prioritizing your financial education. Learning and then applying the strategies that people in the B and I quadrants use. That's the path.
It starts with that first step of deciding to learn.
It really does. So I seriously encourage you, take that first step today. Head over to BullishBooks.com. You can read the full Escaping the Salary Monkey Trap article there. Plus, find a lot more content on all these topics we discussed.
Explore the site. See what resonates.
Yeah, check out the other articles, the resources, and definitely subscribe so you get notified about future deep dives like this one. We'll keep exploring these ideas.
Continuous learning.
Exactly. And I'll leave you with this final thought to chew on. What specific fruit, what comfortable belief or habit are you holding on to right now that might actually be keeping you from the financial independence